Are we in an AI bubble? And if we are, how bad is it? Welcome back to the AI Breakdown. When we talk about bubbles in technology, there are really two different possible dimensions of that. One is referring to the idea that the technology is all smoke and mirrors and not really advanced. The other is the idea that it's mispriced somehow by the markets, that market enthusiasm has outstripped the capacity of that technology to deliver value in the real world as it exists currently. Today, we're talking about the market side of a potential AI bubble. For the last few weeks, smart analysts have argued both sides of this, that AI is overvalued, overhyped, and overbought. But then at the same time, some have argued that we're still not understanding just how disruptive and transformative it is. This conversation heated up a couple of weeks ago when a really fascinating thing happened. For everything outside AI, the main discussion and what was shaping market action was the debt ceiling debate. House Speaker Kevin McCarthy and President Biden couldn't get it together, and we were careening into the US's first debt default in history. Still, as that happened, Wall Street wasn't in turmoil the same way that you might expect, and part of that was that Nvidia was leading a rally the opposite direction. The CNN article starts, "The debt ceiling debate and possibility that the United States could default on its financial obligations have hung over the heads of investors for nearly 6 months now. But Wall Street appears to be largely shrugging off the ongoing negotiations as noise, instead opting to focus on a better-than-expected first quarter earnings season." Now, of course, the Nvidia earnings weren't just good, they were spectacular, historic even by Wall Street standards. They revised up estimates of quarter one revenue and profit in a way that beat analysts' expectations, but even more, they blew current quarter estimations out of the water. Analysts had expected current quarter revenue of around $7 billion for Nvidia, and they estimated it to be closer to $11 billion. The net impact of that was that Nvidia joined the rarefied air of the trillion-dollar valuation club. However, even before Nvidia, some were saying that we were in an AI bubble. Bank of America, in a report, called it a baby bubble that echoed the dot-com era. Michael Hartnett, the chief investment strategist at Bank of America Global Research, wrote in a note that bubbles, whether they're investing in the right things or the wrong things, are always started by easy money and are always ended by rate hikes. Hartnett pointed out that the speculative mania in the late 90s and early 2000s was one of the driving reasons that the Fed restarted monetary tightening. Others were a little bit more measured in their bubble talk. Fundstrat, for example, said that they thought that mega-cap tech stocks were overbought and that their rally was close to stalling out, but that investors were right to be optimistic about AI. Others suggested that the rise of a stock like Nvidia was creating a bubble by making people think that other tech stocks were going to follow along, even though Nvidia was exceptional. Therese Paletti wrote, "Nvidia increased the fervor for artificial intelligence on Wall Street, but plunging software stocks showed Thursday why betting that the chipmaker's AI revenue will quickly ripple through the rest of the tech sector is a losing proposition." Therese pointed to C3.ai, which fell 14% after giving soft revenue guidance, CrowdStrike, which fell 12%, Salesforce, which lost 6%, and Okta, which dropped 16%. Therese writes, "Those companies largely beat expectations, both for results and guidance with their reports, but did not provide anywhere near the level of Nvidia's audacious forecast. Investors likely had outside expectations heading into the results after bidding up software stocks in the past month." Therese points to comments from an analyst regarding C3's results as emblematic of Wall Street's view more broadly. Jordan Berger, an analyst at Third Bridge, wrote, "Despite AI optimism, we are hearing from our experts that generative AI is unlikely to represent a significant revenue-generating opportunity for the company, and more likely represents a means for augmenting the user experience and searchability of the current platform. The company reported progress towards deploying generative AI technology within its platform, but how this will translate to revenue upside remains to be seen." As always in this type of situation, it pays to focus on the specifics, not just the generalities. The layer one basic analysis was Nvidia equals AI equals going up, so other companies that equal AI equal going up. But Nvidia is a unique company. They are the primary manufacturer of a key component of the entire AI movement, which is, of course, GPUs. Right now, the demand for GPUs radically outstrips the supply because of the rise of ChatGPT, Midjourney, Stability AI, Runway, and all of these other AI tools that are now entering the mainstream. Indeed, in a recent conversation with third-party developer partners, OpenAI's Sam Altman said that their roadmap was suffering because of this GPU shortage. Big fundamental features that they had wanted to bring to market this year, including a longer 32,000 token context window, as well as multimodality, are in the waiting wings now because they simply can't get their hands on enough GPUs. The point that this is about AI, but it isn't widely applicable to every company outside Nvidia. On top of simply learning the wrong examples from Nvidia, some say that people's focus on AI is making them completely ignore the larger macro environment. Contrarian bear David Rosenberg said that the price bubble in AI stocks could actually wreck the rally. No question we have a price bubble, he said to CNBC's Fast Money last week. And in a recent note, he warned more broadly that the stock market rally probably doesn't have legs for long. Rosenberg wrote, "There are breadth measures for the S&P 500 that are the worst since 1999. Just 7 megacaps have accounted for 90% of this year's price performance. You look at the tech weighting in the S&P 500 and it is up to 27%, where it was heading into 2000 as the dot-com bubble was peaking out and soon to roll over in spectacular fashion." Just today, Bloomberg published a widely shared piece called "AI Stocks Supercharge a Tech Bull Market and Maybe a Bubble. The sudden frenzy over bots gives investors a powerful, if scary, new story to latch onto." Now, what this article points out is that there's more than just the traditional FOMO dynamics going on right now. Bloomberg quotes Vincent Dillard, the director of global macro strategy at StoneX, who said, "It's not just FOMO. My impression is that it's FOBR, fear of being replaced. Basically, we think, oh my God, AI is going to take over the world, my job. And the only way I can hedge it is by owning the damn robots. So you buy Nvidia, you buy Microsoft." Cam Harvey, a finance professor at Duke University, said, "We've seen this before. Something gets hyped, companies start to change their name so that you can inject AI directly into the name. AI is mentioned on conference calls, company websites, and public releases. It can go up very fast and come down very fast. This is not just talk. Consider the history of things that get hyped. That's exactly what happens." Mark Dow tweeted something similar, saying, "All of a sudden, every business has to be able to explain to their board what their AI strategy is. Asset managers are now going to have to do the same. If you don't have an AI strategy on your books, you're going to have to get one, whatever the valuations." Still, not everyone is as convinced. Legendary investor Stanley Druckenmiller recently sat down with Bloomberg Invest and had this to say about AI and Nvidia.
Do you think that all of AI makes it through this recession, or do you think that some areas of the market, particularly in AI, start to look like they're in bubble territory?
Well, all of AI is not going to make it through whether we have a recession or not, because they haven't separated the wheat from the chaff yet. But I do believe, I think AI is real. It could be as transformative as the internet. It's a huge thing. And I think I've argued publicly that if staples can go up in price in a recession, why can't a company like Nvidia, if their orders and earnings go up 70% in a hard landing, which is what I think would probably happen, it's not clear that Nvidia goes down despite the lofty valuation level. If this is a secular move, if this thing is real, I mean, it's already making the top coders 7 to 8 times more productive than they were 5 months ago. If it's as big as I think it is, Nvidia is something we're going to want to own for at least 2 or 3 years, not for 10 months, and maybe longer.
Now, one thing that people seem to agree on is that AI, from a bubble perspective, is certainly less bubbly than crypto was just a couple years ago. Nicholas Bonsack, the president of Strategas Securities, said, "If I were to use past frenzies as a reference point, it's nothing like people saying to me 2 years ago, what coin should I buy? The crypto craze was on a whole other level." Wharton's Jeremy Siegel also said that it's not a bubble yet. He recognized that hype around AI plus Nvidia's earnings statements maybe got the stock a little out of sync with reality, but that it didn't constitute a bubble at present. He said, "In the long term, I would say Nvidia shares were probably slightly overvalued. But for the short term, we know momentum can carry stocks far higher than their fundamental value, and no one can predict how high they might go."
Are you suggesting that these AI stocks are a bubble?
No, they're not there yet. I mean, they got real earnings. I mean, they got real earnings behind them. I'm not saying they're not eventually going to go too high, but I think we threw out a bubble way too easily. I mean, to me, a bubble is a stock that's 4 or 5 times above its fundamental values, and I don't think we're anywhere near that then.
Others are putting some numbers behind this. One analyst, Michael Goldstein, has said that AI stock valuations just aren't near the levels yet that we've seen in past innovation bubbles. The managing partner of Empirical Research Partners said, "The relative forward PEs of today's AI leadership are still a far cry from what we've seen at the peaks of past innovation waves. In fact, they sit close to the level reached a year before the tops." Now, this might not be the case forever, Goldstein said. The combination of record-setting relative returns and the stock's elevated arbitrage risk suggests it won't take too much to create a correction. But on the whole, the valuation of the stocks doesn't yet look excessive. Whether we're calling it a bubble or not, it's pretty clear that investors are piling into the space. Tech funds, for example, saw record inflows of $8.5 billion in the last week of May. But whenever we talk about market prices, it's important to differentiate short-term from long-term. Part of why AI is capturing so many people's imaginations is that it seems like it could be the root of a productivity boom, the likes we've not seen in a very long time. In May, Goldman Sachs senior strategist Ben Snyder told CNBC that over the next 10 years, AI could increase productivity by 1.5% per year. That, Goldman believed, could increase S&P 500 profits by 30% or more over the next decade. Just this week, Goldman wrote another note in which they said, "We assume that widespread AI adoption occurs in 10 years and lifts trend real GDP growth by 1.1 percentage points for 10 years. In this scenario, earnings per share in 20 years would be 11% greater than our current assumption, and the S&P 500 fair value would be 9% higher than today, holding all else equal." The analyst went on, "However, a wide degree of uncertainty exists around the potential productivity boost and the ability of firms to translate AI into increased profits for 10 years. Based on a range of productivity scenarios, we estimate the benefit to S&P 500 fair value could be as small as 5% versus current levels and as large as 14%. Legendary hedge fund investor Paul Tudor Jones said something similar, saying that AI will spark the next productivity boom. He said, "I think that the introduction of large language models, artificial intelligence, is going to create a productivity boom that we've only seen a few times in the last 70 years. So how should you play it? Well, to be clear, this is not a financial advice podcast in any way. So I'll leave you with a couple of quotes from Twitter. Tom Shaughnessy from Delphi Digital says, "AI is definitely in a bubble. Same as every last tech breakthrough. The bubble attracts mass interest, but as humans, we always get ahead of ourselves. So should you stay on the sidelines? Absolutely not. Just be valuation sensitive and focus on long-term people." Alex Good writes, "If you treat AI as an investment bubble, you might be right. But when you approach something as a fad, you're keeping yourself from meaningfully engaging with it and using it as a tool." I agree with this. I think it's important to separate what you think about AI market prices and stock PE ratios from AI as a technology category. And of course, even within the technology category, there's no way that the vast majority of the venture capital pouring in right now is actually going to return. There will be big winners and far more losers. But the technology's entrance into the mainstream is not just an accident, a fad, or a hype cycle. People are using ChatGPT because they recognize how much it can do for them. Anytime you have that sort of seismic shift, it's worth getting engaged. Anyways, guys, that is it for today's AI Breakdown. I hope you found this useful. If you did, please like, subscribe, and share. Click that notification button so you don't miss an episode. Go check out the podcast version. I would love for you to listen to this show or subscribe to the newsletter. All of that information is down below, and I appreciate wherever you consume this content. Until next time, peace.